The warning sirens aren't just echoing, they're howling, shrieking, rattling the foundations of global finance. They're not whispers in the distance, they're thunder crashing at the gates. And at the core of this storm stands U.S. Treasury Secretary Scott Besson, who didn't approach the world's financial elites with courtesy, compromise, or partnership. He arrived with an ultimatum. He wasn't a statesman, he was a salesman on the brink, declaring, "Buy American assets," as if it were still 2005, as if Washington still dictated every rule, as if the dollar still sat untouchable on its throne. But it didn't sound like confidence, it sounded like coercion. Buy our debt or suffer. That wasn't strategy, it was panic dressed up as power, desperation cloaked in arrogance. And the cruel irony? The dollar is disintegrating anyway. Since January, it has hemorrhaged more than 10% against the world's dominant currencies: the yen, euro, pound, Canadian dollar, Swedish krona, Swiss franc. Not a stumble, not a dip, the sharpest collapse in 50 years. Half a century of stability erased in months. Investors aren't lingering to see what happens next, they're bolting. The world isn't just backing away, it's abandoning ship. And who can blame them? The U.S. is shackled to $37 trillion in debt, a mountain so towering it casts a shadow over generations unborn. And instead of slowing, Washington accelerates, announcing another $514 billion in borrowing this quarter alone. At this velocity, nearly $2 trillion more will be added before year's end. This isn't leadership, it's lunacy. And the retreat is unmistakable. In April, foreign investors offloaded $71 billion in U.S. bonds, torching their positions. China led the exodus, dumping $23 billion, while global capital surged into gold, $15 billion in a single day. That's not cautious repositioning. That's a stampede. Confidence in the dollar isn't eroding, it's vanishing into thin air. Yet Washington presses on. Tariffs on Chinese imports have exploded to 50%, shredding long-standing trade pacts like they were worthless scraps. Apple faces nearly $900 million in new costs this quarter alone. Imports have cratered by 19%. And through it all, Besson beams like a steady captain, while the vessel keels over, seawater flooding the decks. Economic growth crawls at 0.3%. Markets tremble. Investors recoil. America isn't radiating dominance anymore, it's radiating dread. Besson's speech wasn't policy, it was performance. He tried to cast the United States as the engine of prosperity, but the delivery wasn't strength, it was begging. A hollow advertisement from a country trying to disguise its fragility. And while he spun his narrative, the scoreboard told the truth. The dollar down 10% since January, $41 billion in bonds liquidated in 2 weeks. Allies like Japan and Germany quietly retreating, unnerved by chaos and volatility. He called the U.S. the anchor of global finance. But anchors don't just stabilize, they can drag vessels to the bottom. And right now that anchor is pulling down. The transformation is undeniable. Central banks are realigning, shifting reserves into euros and bullion. The Bank for International Settlements confirms it. The pivot is underway. The dollar's crown is cracking. Already 38% of global trade bypasses it entirely. And Besson's solution? Tax cuts and deregulation. Congress warns it will carve a $2 trillion crater in the deficit by 2030. That's not a cure, that's freefall. The deeper tragedy? It doesn't matter whether Besson believes his lines. What matters is whether the world believes him. And they don't. HSBC reports a torrent of capital flight. The euro has vaulted from 1.09 to 1.3 in weeks, an 11% surge. Why? Because even 5% yields on U.S. bonds can't tempt investors if the currency itself is dissolving. The IMF verifies it. July unleashed a tidal wave of de-dollarization. Nations are decoupling, cutting ties, walking away. And that isn't a mere adjustment, it's existential. The dollar isn't just money, it's the scaffolding of America's debt system. Strip it away and the entire structure doesn't bend, it shatters. Still, Washington chants safe markets, but safety without trust is illusion. Liquidity is meaningless if everyone rushes for the exits at once. This isn't a fortress, it's a burning tower. And the trade war? It isn't crippling Beijing, it's gutting America. Tariffs don't punish rivals, they punish citizens. As of May 2, 2025, even sub-$800 shipments are taxed. Apple alone shoulders $900 million this quarter, $3.6 billion annually. Ports are jammed, retailers scrambling to beat tariff deadlines. July imports are set at 236 million containers, up 2.1%, but only because businesses are hoarding in panic. The cliff comes after. August imports forecast to fall 10%. November, 21%. This isn't speculation, it's scheduled collapse. The cost? Americans pay. Small businesses are already buckling. The National Retail Federation warns, planning is impossible, shelves will thin, prices will soar. Stability, the foundation of commerce, is gone. Tariffs new and old collide, creating chaos. Even Christmas sales are under threat. The U.S. Chamber of Commerce says profits are collapsing, 40% wiped out in electronics, solar panels, chemicals. Prices rose 2.4% in May, 2.7% in June. These aren't numbers, they're bruises. And it spreads. Logistics giants like Maersk report 15% higher costs as shipping routes are rerouted, blocked, strangled. The supply chain, once a machine of precision, is now a snarl of chaos. Besson preaches resilience tomorrow, but businesses need oxygen today. You can't tell a drowning man to wait for rescue. If Apple, the richest corporation alive, is choking, what hope does a family-owned shop have? And under it all lies the bitter truth Washington refuses to utter. America cannot stand alone. Not financially, not commercially, not without China. For decades, a myth ruled policy, the myth that China needed America more. That illusion fed arrogance, shaped wars, dictated diplomacy. But illusions don't last forever. America is more dependent on China than it dares confess. Not just for consumer goods, but for capital. China still holds over $750 billion in U.S. debt. That is not just a number, that's a blade. If Beijing ever unloads even a fraction in bulk, U.S. interest rates explode, markets convulse, confidence implodes. For decades, China has been America's most dependable creditor. But patience has limits. And the day Beijing decides to strike, the illusion of American invulnerability won't just flicker. It will collapse in flames. China is not whispering change anymore. It's thundering it across the global stage. Gold, euros, commodities, this isn't diversification, it's defiance. It's Beijing looking at Washington and declaring, "We will no longer bankroll your deficits. We will no longer play your game." And behind that defiance lies something even more potent: resources. China commands 80% of the world's rare earth minerals, the lifeblood of modern civilization, powering smartphones, satellites, electric cars, and the weapons of tomorrow. The U.S. has no fallback, no quick fix. Mining rare earths at home isn't a 12-month sprint. It's a 20-year grind, an environmental, financial, and geopolitical gamble. The fantasy that America can simply cut China off and replace it with another supplier collapses the moment you look at the numbers. No other country delivers the sheer scale, the precision, the speed. And China knows it. That's not leverage. That's supremacy. Built not in headlines or fanfare, but in decades of deliberate, methodical strategy. The world, too, has been shifting. Not suddenly, but steadily, almost imperceptibly at first. Away from the dollar. Away from American promises. Away from the illusion that stability meant permanence. While Washington printed, borrowed, and postured, Beijing built. The Belt and Road Initiative was never just about roads and ports. It was about weaving an alternative world order, connecting Asia, Africa, and Latin America into a network of influence, debt, and loyalty. While the old guard unraveled, China was constructing bridges, economic, political, and strategic. The dollar was no longer the foundation. And when trust in that foundation cracked, nations didn't just step away, they bolted. Not into another paper empire, but into the one store of value that has never failed in 5,000 years of human history: gold. And in 2025, that truth became undeniable. In July, gold surged to $3,500 an ounce, up 40% in a single year, as panic buying swept across the world's central banks. China and Poland led the charge, together seizing 244 tons. China quietly absorbed 50 tons in February alone and kept going. Poland, already the world's biggest buyer in 2024, added another 90 tons, pushing gold to 20% of its reserves. But they were only the visible tip of the iceberg. According to the World Gold Council, 95% of central banks are still buying gold, and nearly 3/4, expect the dollar's share of global reserves to plunge to 57%, 10 points lower than just 5 years ago. The BRICS nations have already moved on, abandoning the dollar for their own currencies in trade settlements. This isn't a future trend. It isn't a warning. It is here. Now. Alive. And the forecasts are turning darker. JP Morgan warns, if the trade war grinds on, gold could hit $3,150 by year's end and smash $4,000 by mid-2026. That's not speculation, that's inevitability. And ordinary Americans, long shielded from the tectonic cracks beneath their feet, are beginning to feel the tremors. Economist Peter Schiff didn't mince words. The era of the dollar is ending. He warned that life in America could change with breathtaking speed. And he is right. A weaker dollar doesn't just mean abstract pain. It means the grocery bill doubles, electronics vanish from shelves, small businesses collapse under higher costs, and supply chains fray under relentless tariffs. While the world fortifies itself with gold, America drowns in debt, clinging to the illusion that someone, anyone, still wants to buy its paper. But what happens if no one does? In just the first quarter of 2025, the U.S. borrowed $514 billion. Interest payments alone have detonated to $1.1 trillion, swallowing 1/5 of all federal revenue. In April, foreign investors dumped $71 billion in U.S. debt. By July, Fitch stripped America's rating to AA, citing fiscal suffocation from tariffs. The IMF followed with a chilling warning: a refinancing shock may be imminent. And then comes Q3, $1.6 trillion in bonds due. Yet the Federal Reserve sits immobile. No rate cuts. Inflation still high. Tariffs fueling chaos. Foreign demand evaporating. Real yields sinking below zero. This isn't steady hands on the wheel, it's paralysis. The strategy? Borrow more. Pretend the storm can be ignored while the roof caves in. But everyone knows the truth. When investors finally flee, the debt bubble won't deflate. It will detonate. And the world isn't ready for the fallout. And this isn't just numbers scrolling across financial terminals. It's in homes, in grocery stores, in the strained silence around American dinner tables. Consumer confidence is imploding, the Conference Board's index hitting a 12-year low. The University of Michigan's sentiment index plunged 16% since December. Inflation expectations may have eased slightly, but optimism has evaporated. Americans are buying only what they must: cars to commute, clothes to cover, medicine to survive. The rest, electronics, appliances, leisure, has fallen off a cliff. In May, retail sales fell 0.9%. Auto sales collapsed 3.5%. Even June's small 0.6% bump was panic buying before tariffs shoved prices even higher. The financial strain is suffocating. A FINRA survey revealed 26% of Americans are now spending more than they earn, the worst level since the wreckage of 2009. Only 44% say they can cover their basic expenses without strain. Credit card delinquencies are surging, hitting the middle class hardest. Banks still feign calm, but cracks are spreading. Consumer debt is wobbling. Commercial real estate is trembling. The Fed is cornered, trapped between inflation too high to cut rates and confidence too shattered to ignore. The calls for relief grow louder by the day, but few truly believe help will come. Behind the curtain, Wall Street knows the truth. They smile for the cameras, issue press releases of stability, but in back rooms and private meetings, fear is spreading. Quiet, corrosive, irreversible. Traders feel it. CEOs feel it. Economists whisper it. The question gnaws: how long can Washington maintain the illusion? How long can it delay, deflect, deny? How long before the mask slips, before the world sees the emperor has no clothes? Because the signs are everywhere. In the vaults of central banks where gold is stacked higher every month. On the trading floors of New York where volatility whispers of panic. In the cash registers of small-town America where essentials are bought on credit and luxuries abandoned. From Shanghai to Sao Paulo, Riyadh to Warsaw, nations are repositioning, realigning, preparing. The old order is not just cracking, it is collapsing. The foundations are breaking apart under the weight of debt, denial, and decay. And what comes next? That story is still unwritten. A world no longer anchored to the dollar. A financial system reshaped by force, by necessity, by survival. What replaces it? Chaos, multipolar order, or something entirely new depends on what happens now. This is not the end of the story. It is the prologue, the beginning of a turbulent new era. And those who fail to see it, who fail to prepare, will be crushed by it. Because history is moving faster than ever. And when the dust finally settles, the world you knew will be gone. Forever.